That's Dwayne Thomas from Stifel Nicholas. Good morning, Dwayne.
Good morning, Jay.
Hey, we're back at it after a day off. What was Tuesday's market? Remind us.
Yeah, Tuesday the market dropped 132 points, closing at 24,175. It was a very light volume day. It was a half a day, and many traders took the day off. But the bottom line is there was fear and concern over the potential trade war, the tariffs that go into effect tomorrow, and that was the negative part of the day and why we dropped a little bit.
It's been a big season for mergers and acquisitions.
It's been huge. First 6 months of the year, a complete record, more than we've ever had, $2.5 trillion in mergers and acquisitions so far announced. This is just a great pace for the people in that side of the business. The reason behind it are, number one, interest rates remain low. I know the Fed's raised it, but when you look at the 10-year Treasury, it's still below 3%. And when you make a big mergers acquisition, you supply it by borrowing money with bonds or paper that's basically 10 years or longer. So it's not about 1 year paying something off. It's paying something off over 10 years.
Sure.
So still low interest rates. Second, the large tax cut in the U.S. allows more cash to go towards mergers and acquisitions. And the pure fact that we've had a pretty long bull market, pretty long cycle of economic expansion, companies have more cash on hand than they've had in years. So if you have more cash, you have the ability to go buy other people as well.
Absolutely.
Examples. I'll give you a couple big examples. AT&T buying Fox Entertainment, CVS Pharmacy buying Aetna, Cigna buying Express Scripts. There's a local one.
Sure.
Walmart buying a company called Flipkart with $16 billion. And of course, the one that just was announced last year but just closed here in town, Bayer buying Monsanto.
Those are huge deals.
Exactly.
The banks, switching gears, have been cleared by the Fed under its stress test.
Exactly. This is, I'm trying to remember, it's the third or fourth stress test that they've done over the last 5 years. And basically the concept of too big to fail. And it's not about saving the bank from a investor standpoint. It's that if a big bank goes under, the economic snowball effect down the line, how it impacts other businesses and jobs and everything else is really important.
Yeah.
So basically, the big banks, the ones that are $50 billion in size and up, have to go through a pretty severe stress test. And they've made the test stricter each time they do it. And so the banks have to have even higher ability. And the stress testing basically looks at the bank and puts in a theoretical rise in unemployment, we're below 4%, to 10%. It includes a 65% drop in the stock market, includes a negative 7.5% GDP for almost 2 years. So just a whole bunch of worst-case adverse conditions, and are the banks going to survive? And the fact is, every U.S. bank passed. The only bank of size out there that did not pass was Deutsche Bank. And so they remain under the additional scrutiny. The large U.S. banks, because they're in such good shape, are allowed to raise dividends and do a few other things that they've been restricted for a number of years from doing.
Interesting. What about today's market? Are we going to get back at it after the holiday?
Absolutely. Right now, we're looking at the market opening up 150 points based on the early futures in the market. But remember, we're dealing with these trade tariffs. We don't know how that's going to play out. They kick in tomorrow. At least the U.S. portion kicks in tomorrow. And, of course, the main thing we're looking at is what's the kickback from the other countries, in this case specifically China.
Yeah, it's going to be some rocky, a bit of a rocky road to get going.
It definitely has a little more tension in the air, yes.
Yeah. Dwayne Thomas of Stifel Nicholas, thank you very much for the morning business call.
Sounds good.